Welcome to the weekly deep dive. If you're anything like me, you probably feel like the amount of information coming out at us right now is a little overwhelming. Honestly, between the AI breakthroughs, the stock market swings, crypto, and the general economy, I found myself reading endless newsletters and listening to podcasts, but barely retaining any of it. I was consuming information piecemeal and missing the bigger picture, and I really hated that. So I decided to fix that. This podcast is my solution. Every Saturday, I sit down to synthesize the chaos of the week into one clear narrative, or as best as I can. My goal here is simple: to practice articulating complex ideas, to ground myself in what is actually happening, and to help you connect the dots without having to read the entire internet. Ultimately, this is a passion project. It's not about the views and it's not about the hype, it's about understanding. So, let's get into this week's synthesis. Looking at the massive stack of research I've got in front of me, it's an absolute mountain of data. We are pulling from a really complex and in some places deeply contradictory set of macroeconomic sources, and a bunch of Wall Street insiders, sort of newsletters, Financial Times, The Economist, Reuters, LSEG, the usual suspects. And honestly, adding liquidity data, crypto market analysis, Federal Reserve employment numbers, and incredibly detailed geopolitical backgrounds or breakdowns, it's honestly quite a formidable pack of intelligence to unpack. So let's get to it. I guess when you aggregate this much of this disparate data, a very specific framework begins to emerge. To borrow a phrase from one of the materials that I've read, we essentially looking at a beautiful ball of chaos. I think it fits perfectly because the market is behaving in ways that completely defy traditional modeling. We have equities hovering near or right near all-time highs, yet simultaneously safe haven assets like gold and silver are surging dramatically. Normally, these move inversely. All of this is unfolding against a backdrop of severe kinetic conflict in the Middle East and a hidden structural stress in the domestic US economy that isn't quite showing up in the headline numbers just yet. So, our objective today is to extract the actual signals from all of this noise and then decode the structural regime change that these experts argue is actively underway right now. But before we get into the mechanics of this regime change, I think it's quick to establish a ground rule. Essentially, there's a lot of highly politically charged material, and with the Middle East sort of war that's ongoing, I just want to be clear upfront that I don't take any sides. My viewpoint is just neutral. I'm just trying to make sense of the puzzle. So to start, let's look at the texture of what is actually happening on the ground. Take the recent military operations in the Middle East. According to the newsletters that I've read, or news articles rather, the US military utilized Claude, the artificial intelligence model developed by Anthropic, to assist in planning recent strikes in Iran. The AI was used for target identification, running battle simulations, and complex intelligence analysis. But the most fascinating part is the sequence of corporate events surrounding it. Right around the time of these operations, the Pentagon and Anthropic actually had a massive falling out, and the core issue was that Anthropic, a private civilian tech company, refused to grant the US military unrestricted foundational access to their technology. Ironically though, the Claude network suffered a major outage precisely during the window of these military strikes. A lot of the sources seems to suggest the infrastructure couldn't handle the localized stress, or a darker theory that there was a deliberate throttling. As an immediate consequence, the Pentagon officially pivoted and partnered with OpenAI, and this is a stark illustration of where sovereign security actually resides today: the literal weaponization of commercial artificial intelligence. When a Silicon Valley tech company can essentially dictate access terms to the Department of Defense, it fundamentally rewrites the military-industrial complex. The government is now entirely at the mercy of private compute infrastructure. That dynamic of control mirrors the corporate survival analysis we see in the crypto materials regarding MicroStrategy and its CEO, Michael Saylor. The analysis details a historical period where MicroStrategy's stock plummeted from $333 a share down to just $42, a 99.8% drawdown. By any conventional metric, that is a total wipeout. Yet Saylor survived. How did he, you may ask? He explicitly notes that the only reason he kept his job in the company wasn't dissolved and sold for parts to a mega cap like IBM was because he held a controlling super voting stake. He had structural veto power over the board of directors. In environments characterized by extreme fear, a board's instinct during a 99% drawdown is total capitulation. Saylor's story proves the absolute necessity of structural control. Without it, the market's volatility will simply shake you out. This brings us to an analysis piece on Duolingo, which provides a stark contrast to that survival story. The newsletter argues that traditional investors, they call them balance sheet nerds essentially, are getting trapped by historical metrics. In a vacuum, Duolingo's numbers are phenomenal. They reported 52.7 million daily active users, a 913% increase, and free cash flows are up by 960%. By any standard metric, that stock should be soaring, yet the equity has been decimated down over 81%. That essentially proves that traditional spreadsheet math is broken in the current environment. Duolingo's entire moat was built on gamification, making language learning a fun mobile game to maintain a streak. But rapid AI advancement fundamentally bypasses that moat. When users have near instantaneous, highly accurate conversational AI translation on their phones, spending months gamifying vocabulary retention loses its utility. The underlying technology rendered their core product obsolete almost overnight. Now, management is sacrificing profit margins in a desperate double or nothing bet to scale to 100 million users within 3 years. They are burning free cash flow to acquire users, hoping pure scale will insulate them. It highlights how quickly a pristine balance sheet becomes totally irrelevant when the technological regime shifts. That leads directly into how the absolute largest pools of capital adapt. The dossier highlights BlackRock's stance on Bitcoin as a masterclass in institutional adaptation. Back in 2017, the CEO of BlackRock, Larry Fink, was vehemently opposed to Bitcoin, calling it an index of money laundering and comparing it to Dutch tulip mania. But by 2024 and 2025, BlackRock had launched the Bitcoin ETF, and it became the fastest growing ETF in the history of finance. It pulled in $10 billion in assets in just 7 weeks, eventually scaling to between $70 and $90 billion. BlackRock ended up holding roughly 2.7% of the entire global supply of Bitcoin. Fink's rhetoric completely inverted. He is now on record, projecting Bitcoin could reach $700,000, calling it the digitalization of gold. Massive capital allocators do not have the luxury of ideological stubbornness. They have to follow the money. When sovereign wealth and pension funds demand exposure, the asset manager must provide the vehicle or lose capital to a competitor. The smart money is inherently agnostic. It moves wherever liquidity and demand dictate. That mechanical adaptation brings us to the core narrative spine of this research. Synthesizing some of Andy Krieger's, for example, macro outlook, trading floor documents, and Wall Street newsletters reveals a sobering, unified thesis. We are not experiencing a cyclical downturn. We've entered a period of profound structural dislocation. Many of whom identify this environment as a chaotic upcrash. An upcrash occurs when nominal asset prices like the S&P 500 are violently rising to new all-time highs, while the fundamental machinery of the economy exhibits severe stress. The numbers go up, but the foundation is cracking. Traditional portfolio managers relying on a 60-40 split are entirely missing the intersection of macro geopolitics and technological disruption that is rewriting the valuation models. And I think it's quite important that we dissect this intersection, starting with the Dawn Row Doctrine. This geopolitical strategy focuses on weaponizing trade flows, specifically utilizing tariffs and engineered energy bottlenecks to exact maximum pressure on global adversaries. Applying this to kinetic strikes in Iran and the closure of the Strait of Hormuz suggests that these are highly coordinated moves. Roughly 20% of the world's entire oil supply transits through this narrow corridor. Think about that. And a lot of the sources theorize this closure is a deliberate, engineered supply shock designed specifically to starve China of cheap energy. By bottlenecking that artery, global oil prices are forced significantly higher, potentially pushing towards $100 or even $200 a barrel. This crushes China's manufacturing output and places immense structural strain on the European Union's fractured energy grid. But this maneuver clearly benefits the US, right? Because oil is priced in dollars globally, rising energy prices increase the global demand for US dollars, structurally strengthening the DXY index. It also massively pads the balance sheet of domestic US defense and energy infrastructure companies like ExxonMobil. And it's quite an important play when you think about it, given the last couple of weeks, we've essentially mentioned that the world is de-dollarizing. The US dollar lost a lot of strength, and you've got to wonder if this is potentially a ploy to get the dollar strength back. So energy and tariffs are blunt instruments on the global chessboard essentially, while simultaneously an AI arms race is happening domestically. These twin accelerators are creating massive bifurcation in the equity markets. So normally macro fear leads to a broad sell-off of equities, but right now inflation and currency debasement fears make sitting in cash a guaranteed loss of purchasing power. Capital is fleeing the middle of the market entirely. Bain Capital explicitly wants that software default rates are spiking into double digits, so liquidity is forced into an incredibly narrow band of companies, essentially the Magnificent Seven mega-cap tech stocks. It is a mechanical necessity. Institutional capital simply cannot hide billions in mid-cap stocks without causing catastrophic slippage. The only vehicles on the planet with the depth to absorb that magnitude of capital are Microsoft, Apple, Google, and Nvidia. They have become the de facto bunkers for global liquidity. The fear itself accelerates the buying of these tech titans, driving the index to all-time highs even as the broader global economy fluctuates. If you take a closer look at S&P 500, besides the Magnificent Seven, very few companies are actually flourishing in the current macroeconomic environment. So let's look at some of the hard evidence driving these models. Berkshire Hathaway reported a 30% drop in operating profits, but their core insurance underwriting took a massive 54% hit. Insurance underwriting perfectly prices macro risks. When Berkshire's incredibly sophisticated models experience that kind of contraction, it indicates unpredictable, severe stress in the real economy. In private equity, Blackstone CEO Steven Schwarmisen took home a record $1.24 billion in a single year. Yet firms like Apollo and Bain Capital warn that broader private equity landscape has entered a Darwinian era of potential fund extinctions. Apex predators extract billion-dollar payouts, while the middle and lower tiers face mass casualties from high interest rates and collapsing software portfolios. Meanwhile, Mr. Elon Musk, on the other hand, is maneuvering through the physical infrastructure side. SpaceX is building space-based data centers, which presents immense thermal and latency challenges. But financial analysis suggests he is using SpaceX's high valuation to secure massive funding to front-run the upcoming IPOs of OpenAI and Anthropic. He creates a narrative that commands premium funding, siphoning capital away from terrestrial competitors right before they tap the public market. And looking at the broader economy, the labor market tells a hidden story. The headline jobs number is effectively a lagging distraction. The actual signal is the mean duration of the unemployment from the FRED database. Historically, this sat between 8 to 12 weeks during economic expansion. Currently, the median duration is sitting at 24.4 weeks, nearly 6 months of active unemployment. The hiring apparatus has completely halted. If you are displaced, you are stranded in economic purgatory. Fintech firm Block laid off 4,000 employees and explicitly attributed it to an AI pivot. These jobs, if you think about it, really aren't coming back when interest rates drop. They've been permanently automated away. The domestic strain is compounded by global trade fragility. A recent sudden wave of US tariffs triggered a 2-day market drawdown that erased $5 trillion in global equity value. Meanwhile, in the Strait of Hormuz, physical traffic dropped 70%, but the ultimate kill switch was the maritime insurance market. Insurers simply suspended coverage for that corridor, paralyzing the entire supply chain. Because of this compounding volatility, option traders have broken their historical models. They are now using the 2020 COVID crash, where the S&P dropped 35% in 35 days, as their standard baseline scenario. So how does the smart money survive this? They utilize a barbell strategy, deliberately abandoning the toxic middle of the market. So what you need to do is then construct a portfolio with intense fortified defense on one end and aggressive, highly asymmetric offense on the other. On the defensive side, Warren Buffett is executing a structural repositioning away from the US exceptionalism. He's issuing massive tranches of yen-denominated bonds, borrowing cheap Japanese money to acquire cash flowing international assets. It is a sophisticated structural short against the US dollar that protects his purchasing power. Capital flight into physical hard assets like gold, silver, and oil is accelerating rapidly as foundational insurance against fiat currency debasement. Institutions assume governments will simply print their way out of sovereign debt crisis, and Bitcoin has secured its position here. Major funds dedicate 2 to 5% of their portfolios to it, viewing it as a cryptographically secure asset immune to central bank inflation. On the offensive side of the barbell, capital is concentrated on the physical infrastructure required to power the AI revolution. The thesis is that software will become commoditized, driving margins to zero. So, you invest in the pick and shovel infrastructure, sovereign hardware, GPU compute clusters, and massive infrastructure energy grids. This leaves the middle of the market as the abandoned, what we like to call kill zone. Any software as a service company acting as a middleman is fundamentally obsolete, and this creates a terrifying systematic risk within the collateralized loan obligations or CLOs. JP Morgan estimates roughly $150 billion worth of these CLOs are at severe risk. Over the past decade, private credit firms loaned massive amounts to mid-market software companies, masking the true extent of their leverage. Now that those underlying companies are facing double-digit default rates, that hidden leverage is detonating. It threatens a Darwinian extinction event deep within the opaque plumbing of private credit. So how do we navigate this? The dossier provides a specific watch list of signals. First is the 200-week exponential moving average, or EMA. 200 EMA of the S&P 500 is what I refer to it as, and it essentially is the golden thread, the mathematical boundary where sovereign wealth and state pensions are contractually obliged to step in and absorb selling pressure. Second is the divergent signal. Historically, when you think about it, investors buy gold when fearful and high-risk equities when optimistic. Right now, both are surging simultaneously, which honestly boggled my mind for a long time. But after doing some research, it's quite clear. So essentially what's happening is institutions are chasing tech growth for liquidity but hoarding gold because they fundamentally doubt the central bank's control over the currency. And the final signal is the employment duration metric we discussed, confirming a hidden recession eroding the middle class. So to wrap this up, I want to leave you with a final analytical lens. Look at the specific entities functioning at the operational center of this chaotic upcrash. The Department of Defense relies on private models for global military strategy. SpaceX is constructing vital data transit infrastructure. BlackRock is dictating the architectural tokenization of the global financial ledger. The core functions of the state are being managed by private sector. At what critical thresholds do these mega cap tax entities cease to be mere investments and begin functioning as independent sovereign nation states? If they control the battlefields, the financial ledgers, and the communication infrastructure, is buying their stock just the modern equivalent to purchasing a government bond? I certainly think so. At least it's looking that way right now. Because it suggests the flight to mega cap tech isn't a bubble, it's a migration into a new sovereign safety. Look, it's been a good almost 30 minutes. I genuinely just encourage you to take a deep breath, review your own macro exposure, and then try to view the market not through historical spreadsheets or through being sort of a balance sheet focused onion, but as the beautifully complex, chaotic mechanism it truly is right now. Thanks for listening to me this week. I will catch you next week.